This is a barrel of Brent crude, the global benchmark, the price that determines what you pay at the pump, what airlines pay for jet fuel, what factories pay for the energy that makes everything else possible. For 50 years, this price has been set in London and New York, denominated in dollars, cleared through Western exchanges, subject to Western rules. As of 6 a.m. Moscow time this morning, that system no longer applies to the world's second largest oil exporter. Russia has announced the creation of a parallel oil pricing mechanism that bypasses every Western financial institution involved in commodity trading. The Russian Urals blend, 7 million barrels per day of production, 7% of global supply, will no longer reference Brent or WTI. It will be priced in rubles, cleared through Russian exchanges, settled through banks that don't answer to Washington or Brussels. The Western price cap that was supposed to limit Russian oil revenues to $60 per barrel? Irrelevant. The SWIFT payment system that was supposed to isolate Russian trade from global finance? Circumvented. The sanctions architecture that was supposed to cripple Russia's war economy? Broken. Not by force, not by confrontation, by building an alternative system and telling the world, this is where Russian oil trades now. Take it or leave it. And 3.8 billion people in China, India, Turkey, Brazil, and dozens of other nations are taking it. This is not about Russia selling oil outside the cap. They've been doing that for 2 years. This is about Russia creating the infrastructure to permanently divorce oil pricing from Western control. The implications extend far beyond Moscow. Here's what they're not telling you. The Western sanctions regime against Russian oil was always built on a fragile assumption that Russia needed the Western financial system more than the Western financial system needed Russian oil. The price cap, implemented in December 2022, was elegant in theory. Western companies would continue providing shipping, insurance, and financing for Russian oil, services Russia couldn't easily replace, but only if the oil sold below $60 per barrel. Russia could keep selling, the world could keep buying, but Russian revenues would be capped at levels that funded groceries, not missiles. For 6 months, it appeared to work. Russian crude traded at discounts. Revenues fell. Western analysts congratulated themselves on finding a tool that punished Russia without crashing global energy markets. Then the workarounds began. Russia assembled a shadow fleet of aging tankers, over 600 vessels now, that operate outside Western insurance markets. Chinese and Indian refiners accepted Russian crude with documentation that didn't mention price, or mention prices that bore no relationship to actual transactions. Turkish intermediaries created paper trails that showed compliant pricing, while cash moved through channels that sanctions monitors couldn't trace. By late 2024, Russian oil was selling at $74 per barrel on average, 24% above the cap. By late 2025, $81 per barrel. The cap had become a fiction maintained by governments that couldn't admit their policy had failed. This morning's announcement makes the failure official. Russia isn't evading the cap anymore. Russia is declaring the cap irrelevant by removing Russian oil from the system the cap was designed to regulate. The new mechanism is called the Moscow Commodity Exchange Oil Platform, MOEX Oil. It launches February 1st. All Urals blend exports to non-Western buyers will be priced through this platform. Settlement will occur in rubles, yuan, rupees, or dirhams, never dollars. Clearing will happen through Russian banks and their correspondent relationships in Beijing, Mumbai, and Dubai. Western traders, Western insurers, and Western banks are explicitly excluded. The price they see on their Bloomberg terminals for Urals crude will no longer reflect actual transaction prices. The market they thought they controlled will operate without them. This is where the lie becomes unsustainable. To understand why Russia's move breaks the oil market, you need to understand how oil pricing actually works, and why Western control of that process has been a pillar of dollar hegemony for 50 years. Oil doesn't trade like stocks. There's no single exchange where all barrels change hands. Instead, oil trades through a web of bilateral contracts, forward agreements, and derivative instruments that reference benchmark prices. When Shell sells crude to a Japanese refiner, the contract says something like Brent plus $2 or Brent minus $1.50, a price linked to the benchmark, adjusted for quality and delivery location. Brent and WTI became the global benchmarks because Western financial infrastructure made them liquid, transparent, and trustworthy. The Intercontinental Exchange in London and the New York Mercantile Exchange provided price discovery. Western banks provided financing. Western insurers covered cargo risk. Western clearinghouses guaranteed settlement. The entire architecture was dollar-denominated and subject to Western jurisdiction. This architecture gave the West enormous power. When the United States wanted to sanction Iranian oil, they threatened any bank that facilitated Iranian transactions with exclusion from the dollar system. Banks complied. Iranian oil was effectively frozen out of global markets for years. When the West wanted to cap Russian prices, they used the same leverage: comply with our rules or lose access to our financial system. Russia just called the bluff. MOEX oil doesn't need Western banks because Russian oil buyers have alternatives. China's CIPS payment system processes yuan transactions outside SWIFT. India's RTGS system handles rupee settlements domestically. UAE banks in Dubai facilitate dirham transactions with Russia without touching dollar clearing. The infrastructure for a non-Western oil market didn't exist in 2022. Russia and China have spent 3 years building it. This morning, they announced it's ready. When the world's second-largest oil exporter exits the Western pricing system, the system itself becomes less representative of global supply and demand. Brent crude prices in London will still be quoted, but those prices will reflect only the oil that trades through Western channels, an increasingly small share of the physical market. Consider the math. Global oil production is approximately 100 million barrels per day. Russian production is 10.5 million barrels per day. Of that, 7 million barrels are exported. Of those exports, 5.2 million barrels go to non-Western buyers: China, India, Turkey, and others who will happily use MOEX oil. That's 5.2% of global supply that will no longer be priced through Western exchanges. Add Chinese imports from Iran, another 1.5 million barrels daily operating outside Western pricing. Add Venezuelan crude flowing to China and India, 600,000 barrels. Add the discount barrels from various sources that trade through Dubai and Singapore without Western documentation. The non-Western oil market is approaching 8 million barrels per day, 8% of global supply. Small enough to ignore in normal times, large enough to matter when supply is tight, and every marginal barrel determines whether prices rise or fall. At 2:30 p.m. London time on Friday, Brent crude spiked $4.70 in 30 minutes on the MOEX oil announcement. Not because physical supply changed, it didn't. Because traders realized that price discovery in Western markets was becoming less connected to physical reality. Because algorithms programmed to arbitrage between benchmarks suddenly faced a benchmark that couldn't be arbitraged. Because the orderly world of dollar-denominated Western-cleared oil trading had fractured into competing systems with no transparent bridge between them. This is what a broken market looks like. Not crashed, broken. 2 pricing systems instead of 1. Opacity where there was transparency. Uncertainty where there was confidence. When global commodities split into parallel pricing systems, everyone with exposure scrambles to understand the new rules. The immediate response from Western capitals reveals the panic. At 8:15 a.m. Washington time, the Treasury Department announced enhanced monitoring of entities facilitating Russian oil transactions, language that signals new sanctions are being drafted but aren't ready. At 9:30 a.m., the State Department summoned the ambassadors of India and Turkey to discuss sanctions compliance concerns, diplomatic theater that both countries will ignore. At 11 a.m., the White House press secretary stated that Russia's attempt to evade international accountability will not succeed, a statement that carefully avoids explaining how. The Europeans are worse. At 10 a.m. Brussels time, the European Commission called an emergency meeting on energy market stability. The meeting produced no statement, no action, no response. The EU's leverage over Russia disappeared when they stopped buying Russian gas in 2022. They have no tools left to influence Russian oil pricing decisions. The only actors with leverage are the buyers, China and India, and they have no interest in using it. Beijing's response to the announcement was a 3-sentence statement noting the new platform and welcoming market diversification. Translation: we're in. Delhi's response was similar: Russian crude at MOEX. Oil prices, likely $8 to $12 below Brent, represents billions in annual savings for Indian refiners. They're not going to refuse discounts to enforce Western sanctions. Less than 8 days remain before MOEX oil launches on February 1st. Between now and then, every major oil trading firm must decide whether to participate in a market that operates outside Western jurisdiction and accept the sanctions risk, or forfeit access to 5% of global supply and the pricing intelligence that comes with it. Trafigura and Vitol, the world's largest independent oil traders, have already opened legal entities in Dubai that can transact with MOEX oil without directly exposing their Western operations. The shell company architecture for sanctions evasion that Russia pioneered is now being adopted by Western firms who want access to Russian volumes. The sanctions aren't preventing trade, They're forcing trade into shadows where Western regulators have no visibility. While one side scrambles, the other side expands. Russia's announcement is only the beginning. The MOEX oil platform is designed to handle more than Russian crude. The Moscow Exchange's technical documentation, published Thursday, specifies capacity for 15 million barrels per day of price discovery, 50% more than Russia's total exports. The excess capacity isn't accidental. It's an invitation to other producers who might prefer pricing outside Western control. Iran is the obvious candidate. Iranian crude already trades in shadows, priced at Brent discounts through murky Dubai intermediaries. A transparent platform, even a Russian-controlled platform, might actually be an upgrade. Early signals suggest Iranian volumes will list on MOEX oil within 90 days of launch. Venezuela is negotiating. Maduro's government has approached Moscow about routing PDVSA crude through the new platform. Venezuelan production is only 900,000 barrels daily, but the symbolic value of another OPEC member exiting Western pricing would exceed the volume. And then there's Saudi Arabia. The kingdom isn't abandoning Western pricing, yet. But Prince Mohammed bin Salman's government has publicly discussed accepting yuan for Chinese oil sales. They've joined BRICS. They've signaled openness to alternatives in ways that would have been unthinkable 5 years ago. MOEX oil gives those alternatives a platform. If 5% of global oil exits Western pricing in February, and 8% by summer, and 12% by year-end, the non-Western market becomes too large to ignore and too liquid to require Western infrastructure. At some threshold, the question flips from, why would you use MOEX oil, to, why would you pay the compliance costs of Western markets? That threshold might be closer than anyone in Washington wants to admit. This is what the end of dollar hegemony in energy markets looks like. Not a dramatic rejection, not a confrontation, just a parallel system that grows until it's no longer parallel, until it's primary for the majority of global oil buyers. Some will argue Russia is isolating itself, that trading outside Western markets means accepting lower prices, reduced liquidity, and counterparty risks that Western systems had managed for decades. That MOEX oil is a desperation move by a country running out of options. These are the same voices that said Russian oil would collapse under sanctions, that said the price cap would hold, that said Russia couldn't find alternative buyers at any price. The voices have been consistently wrong because they assume Western institutions are irreplaceable. For Russia, China, and India, 40% of the world's population, those institutions have become replaceable. Others will recognize what February 1st actually represents: the formalization of a bifurcated global energy market, the end of dollar-denominated oil as the universal standard, the creation of infrastructure that allows nations to trade outside Western oversight, infrastructure that, once built, will be used for far more than Russian crude. The informed are not predicting the dollar's collapse or America's decline or any specific outcome. Predictions require certainty that doesn't exist when systems this fundamental shift in real time. What the informed recognize is that the system is shifting, that Russia has spent 3 years building alternatives to Western financial infrastructure and is now activating them, that 3.8 billion people live in countries that have declined to enforce Western sanctions and will happily use a Russian pricing platform if it offers better terms, that the leverage Washington assumed it had over global energy markets was always contingent on there being no alternative, and now there is one. This is not financial advice. This is not a recommendation to buy oil or short the dollar or take any position based on Russian market announcements. This is simply an observation about what happens when the world's second largest oil exporter decides Western pricing no longer serves its interests and builds a system that serves them better. The barrel of Brent in London will still have a price tomorrow. The price will still be quoted in dollars, still trade on Western exchanges, still clear through Western banks. But that price will represent a smaller share of global oil. That system will govern a smaller share of global trade. And the assumption that Western institutions control energy markets, the assumption that has underpinned dollar hegemony for 50 years, will be a little less true than it was yesterday. February 1st, 8 days. MOEX oil goes live. Russia hasn't crashed the oil market. They've built another one. And the world is about to discover which market matters more.